tax planning, the income planning, and then the investment plan.
Mm-hmm.
They all are incorporated together. And if you are missing one piece, then the rest of your plan is going to be lacking as well. And so it's important to have all of those pieces fitting together.
Branden Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Branden Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
Carisa is relatively new with us at the firm. She's got years of experience in the industry, a different background than I have, coming from more of the institutional side with advanced banking, and then just has a different perspective and mindset about all of this stuff than I do. And so she's a really good complementary asset. So we're always excited to have, non-correlation of not just assets, but thoughts. And with that, Carisa, I asked you to, what do you want to talk about today? And you said helping entrepreneurs build wealth.
Yeah. I mean, I think that this is just something that I've been coming across a lot lately with clients, and then also with family members and myself personally, like the focus on building your business and putting everything you have into it, but also how do you grow your personal wealth? Because one experience that I had, and this is kind of driving this conversation and this thought process, is I had a conversation with a gentleman a couple months back, and he was always kind of an entrepreneur, kind of a person, and he owned a business. In his business, he was super successful. He had the opportunity to kind of step back and do more of the management stuff, but he didn't really need to do the day-to-day anymore. So he was kind of stepping into almost like a part-time retirement status. Okay. But he had always only put all of his assets, everything back into the business. He wasn't investing in other income sources or other investment opportunities to support his lifestyle and his retirement in the event that something went wrong with his business. Mm-hmm. And unfortunately for him, it did. There were different regulations through the city code and different things that came up. And unfortunately, he was not in a place that he was able to kind of pivot and adjust with his business to all these new regulations and codes.
Yeah.
And so he ended up having to sell his business for pennies on the dollar to the next company coming in to salvage that. And there went his retirement plan. And so I think it's super critical for business owners and entrepreneurs, especially, to understand that, yes, it's super important to grow your business. And obviously, like, that's your whole mindset as an entrepreneur at first. But also understanding that you need to have different revenue streams and essentially to invest for yourself and provide for your wealth as well as your business.
Yeah, I always think about it just like any portfolio, right? Concentration risk. Mm-hmm. And I've been through it personally, right? We've had valuations done on our businesses. I have a pretty good understanding what my business is worth. And it's so easy for entrepreneurs because if you look and say, okay, I have $1,000, I can reinvest it in my business and it gives me this huge return, right? Because I can increase my cash flow. I can, increase the valuation of my business if I invest that in, gathering new clients or production or whatever, right? And I tell people all the time that are entrepreneurs, like the biggest ROI you'll get on any investment is really typically in your own business. But the reason why is because it's you producing that result, right? You're the business owner, you have more control on that. And it's also very active income, right? So it's not that you just get to put $1,000 in your business and then it just kind of bakes and provides a return. It's that you're going to work alongside it, right? And that's what produces that outsized return. And that is the power of entrepreneurship. And then, being able to sell that business someday, or being able to move entirely into a, if you look at the cash flow quadrant, right? Employee, self-employed, business owner, investor. And going from, maybe business owner to investor where you're totally passive and other people are running the company, you've just kept equity that keeps paying, that's the holy grail, but that's not the reality for a lot of people. And so one of the things that I always look at is, okay, in the real estate world, a lot of times people will talk about this. They say, gross profit to net profit, but net profit to net worth. And that's where I think a lot of entrepreneurs miss it, is that net profit to net worth. They think net profit, circle back and build more gross revenue. But it's a net profit to net worth. And the net worth is really what counts. So now to tie the whole conversation back to position sizing and concentration risk, right? You need some other stuff to insulate the risk. And if that's, you might be a pretty risky investor, but even just adding other assets that are, maybe institutionally considered risk assets like equities or whatever around your equity in your own business, you can start to diversify out your portfolio and lower the risk, which lowering the risk sometimes can increase your chances of success.
Yeah, absolutely. And I think it's super critical to have multiple revenue streams or multiple income sources, whether that's even within your own business or, from different types of investments as well.
Yeah.
I think that's something to consider. I think a lot of business owners saw this during COVID, and maybe not so much here in Southern Utah, but I think that the businesses that survived and did the best were the ones that could pivot and adjust a little bit more, or had the additional revenue streams and income sources in place already.
Yeah. Or I'm not going to say what I was going to say. Politely, maybe they got some help from.
Yeah, we're not going to go there.
From the government.
We're not going to talk about those PPP loans.
But
I guess an example of that.
Well, so I don't want to misguide on kind of what my thought was. I'm trying to develop it in a way that I can convey it accurately here. Multiple revenue streams are important, right? You want diversification of income, the same that you want diversification of assets. Some things that people miss sight of, though, is that you can build an income stream without turning it on. Right. So you can build a revenue source without turning it on. And a great example of that is just retirement accounts, right? So people save into this asset bucket, if you will. And the intent of that is to actually turn it on as an income source at some point, right? It's not necessarily a savings account that you're just going to pull cash out of the same way, right? You actually have to turn it into an income source. Now, there's products out there that do that, right? Like an annuity will do that for somebody. But you can annuitize essentially your own account by coming up with a portfolio that you believe will do okay, and then taking a distribution at a specified rate from it, right? Now, when you have an insurance company do it for you, it provides you guarantees that you're not going to, run out maybe or something like that. But there's trade-off with that, right? You lose maybe upside potential, right?
Liquidity losses, potentially.
Yep, liquidity losses. You might take on additional risk, like the insurance company going out of business, right? None of those things make annuities bad. I am not a huge annuity person. Anyone that knows me knows that I'm not, a big annuity lover. I don't know how else to describe it. Proponent. Yeah. I think they just like anything else, they have an appropriate place, and used appropriately, they can accomplish effectively accomplish a goal, right?
Yeah. I mean, I think that's with anything in personal finance we've talked about before, like just making sure you're in the right thing.
Right. But going back to the business owners, one of the things that I see people get discouraged of when you say like, okay, multiple sources of income or multiple streams of income, or it's this big conversation that goes back to this, one of these old quotes, right? Like millionaires have 8 sources of income or whatever, right? And there's this big controversy because yes, that's true, but oftentimes they only had one that got them to be a millionaire. Right. So they got to millionaire status and then they started diversifying maybe. And that I think that's a very valid principle to pay attention to and understand that, again, most business owners are going to, that reinvestment into their own business is what's going to propel them to be a millionaire oftentimes. But also being able to take that and say, okay, well, we also need to carve off money to insulate this whole thing, right? Because there might be times when maybe your business needs an injection of liquidity and it's better to, buy more shares of your own company effectively, right? Like buy your own equity. Then go to the market and start selling part of your company. Yeah. Or maybe taking on debt at a high cost from the marketplace. Maybe it's just managing personal finances differently. And then at a certain point it is just, again, building other assets. But just because you start building other assets that you can turn into income streams doesn't mean you have to do it right now. So you can focus on that one important one that is paying the bills, that is cash flowing heavy, and you can just start building other assets. And then if something happens to the main one, you can say, okay, I'm ready to turn on these income streams if I have to. A great example of that is real estate. People get real estate and they want to look at, okay, I could get $150 a month on this, right? I bought it with a loan and, tenants pay me this much and I got all this cost or whatever. And I get an extra $100 a month now in cash flow. And I'm like, stop trying to take the cash flow on that right away. Build up your reserves, pay down the debt on that asset, let the rents rise over time, and then turn it on when you're ready. Like if $100 isn't going to make a difference to you right now, continue to, grow the equity in the asset, right? Sort of, roll it back in or keep reinvesting that. Turn on the income stream when you need to. Yeah.
I think another example or kind of like another avenue of that idea of additional income streams is even within your own business. So like, for example, let's say you have like a pastry shop or something like that, right? And they're, they've got their local customers and they're coming in and, they have their local customer base, but they're wanting to continue to grow and have other sources of revenue from that, right? Well, maybe another option for them is they can start offering classes. They could start doing, like baking classes, or they could start doing catering, other types of things, even within their own expertise, within their own business, that gives them a different line of income so that if there's something that happens to that one source, maybe, sales are going down a little bit because people are not walking by the store as much for some reason. There's construction going on or something, but they're having a ton of catering orders coming through. Like you can offset your income by having different income sources and different revenue, even within
specifically
your own business.
In the business. Yeah, that's, and I don't think we're totally out of alignment on what we're trying to say there. I think as a young entrepreneur, if you're early in business, I would caution people to get too eager about diversifying the income streams, right? Like if you're using a pastry shop as using a pastry shop as an example, just sticking with that, if you open up and the first week sales are a little light and you say, okay, I need to add another income stream. I'm going to start doing classes. I'm going to start doing this. I'm going to start doing that. Right. And all of a sudden you've never mastered just being a great pastry shop. Yeah. That's the main source that's going to really feed and propel you to the next level. Everything else is an insulator, an ancillary, an alternative. And you're kind of starting to explore other options, but you have to do that when you have the time and resources ready to commit to that type of stuff.
For sure. I think you definitely have to be very focus on that first one and almost perfect that first before you pivot and add those additional streams. But I think that's another way that you can invest in yourself, invest in your business, because then you can take those additional profits that you're getting from that second revenue stream, and then you can use those in other ways to help benefit yourself for your retirement, or, what other options that you're choosing to utilize at that point. But that's kind of the growth aspect, I guess, once you get to that sweet spot.
Yeah.
Per se. So.
Yeah. I always love talking about the book Profit First. Mm-hmm. I don't know if you've ever read that. I think it's super helpful for entrepreneurs that in particular are not very sophisticated with financial management, right? Mm-hmm. They don't have the CFO brain. They know that if they reinvest money in their business, they can, really grow it. That is to have the CEO mindset and understand that if you reinvest money back in your business, you can grow the business, is both a gift and a curse.
Yeah.
Right? It's a gift because you know how to do it and you can get great returns. It can be a curse because if things go wrong at some point, they can be going great and then one day go entirely all wrong. And you've grown this whole business that has never given you any profit. There's no profit to it. You've never taken money out, right? You've reinvested everything. So the book Profit First really helps to help people understand that you can have both. And actually, as entrepreneurs, typically, if we limit ourselves to how much we can reinvest in the business, we will actually find the most important things to do with that money instead of just saying yes to everything. And one of the things that the most successful people do and the highest net worth people do, and I've not only read about this, but I've seen it from my highest net worth clients, is that they say no to a lot of things, right? They really know how to say no to a lot of things. And so by doing that, they're able to say yes to the right things.
Yeah.
And I think that's what Profit First does, right? If you've read that book, it helps you limit how much you reinvest into your company, not because it's a bad place to reinvest money, but because it forces you to really, as that CEO brain, hop in the driver's seat, take a second and say, I only have X dollars to amount. I'm not going to break my rules and, put more money in.
Yeah.
I'm taking the rest as profit, so what do I need to do with this money? And you already have that CEO brain to know if you reinvest in your company where you're going to get the best ROI. Mm-hmm. So now you really make sure that you sharpen up that skill. It's a super great book for people to read.
Yeah.
I've seen it work and change people's lives quickly, multiple times.
That's awesome. Yeah, it's a great book. I guess kind of what I wanted to include in this conversation today as well is just kind of maybe some simple steps that small business owners can do, even if they feel that they're not at the point where they're ready to, take that other step to start investing outside of their business. I think there's other ways that you can do that as well. The first one, we've kind of talked about it, investing in yourself and your education, making sure that you sharpen up on your skills and, you're going to workshops, classes, like educating yourself and making sure that you are the best that you can be within your business. That's a different type of investment, but I think that it pays in dividends.
Wasn't it Ben Franklin that said something like that? I think he said an investment in knowledge pays the best dividend.
I don't know.
Something along those lines. I'm pretty sure it's Ben Franklin.
That's a good quote.
Anyways, so love that. Best place to invest money sometimes is absolutely yourself. Yeah. Okay. I like that.
So I think that's something important. Another thing that I see fairly often is a lot of business owners, as soon as they start to see success within their business and they start to have more income than maybe they've had before, they're starting to keep up with the Joneses. And I think it's really important to have that mentality of living below our means and making sure that we are being smart with where our money is going. Because a lot of times people will say like, well, I don't have money to invest, but yet they're out buying like ATVs and a boat and brand new truck because they can write that off on their business, like different things like that.
Don't get me started on the write-offs.
But I mean, just really being strategic about where you're putting your money and what you're doing with it. Is it providing value for you, whether that's within your business or within your personal life? Yeah. Mm-hmm. And not just spending because, oh my gosh, now I have this money. I can buy all these things that I never had money to purchase before, because then it's just going to go away.
Yeah. Well, I think a lot of times people, there's so many misconceptions about IRAs and 401ks out there. And they always say, okay, you save all this money and then, you end up and you're going to have to give half of that back to the government in taxes as you pull it out. And I'm always like, okay, a good withdrawal strategy is going to limit your tax liability. You should be able to do far better than that, especially in the state of Utah. And even better if you're in a state that doesn't have state income tax at all.
All right.
However, you've grown, let's say you've grown a $1 into $1,000. And even if you had to pay an absurd tax rate of 50%, you still have $50 or sorry, $500, right? If you take that dollar and you buy a truck you didn't need, and then you write it off, you have one of two problems. If you sell it for, money. Well, I don't know what else you'd sell it for, but if you sell it and you make money, right? People give you money and you depreciate it down to zero, you're going to pay recapture tax likely. It's not uncommon that I would see that people, when they're using the strategy, like the recapture tax is actually higher than what their income tax liability would have been. So it's kind of almost backwards anyways.
Yeah.
But even if you don't sell it, and you just keep the truck, you write it down to zero, and eventually the truck's pretty much worthless, right? So now you have half and nothing. You just had $0.
Yeah.
You had a truck along the way, but you had nothing. You know what I mean? Yeah. So this concept that if you take a tax advantage to put money in an IRA or a 401k or whatever, tax chassis you choose, that it's somehow a bad deal because you have to pay tax on it later. It's just you're failing to complete the full plan, which is not just put the money in, but then grow the money. And then the third part is have the tax efficient way to start turning it into an income stream, right? And there's a lot of planning in that whole process, which is why we typically meet with clients, somewhat regularly, to make sure that we're helping across that whole time frame and making efficient decisions.
Yeah. Well, I mean, you just hit on like three of the main things in our one-page plan analysis that we do is that tax planning, the income planning, and then the investment plan. They all are incorporated together. And if you are missing one piece, then the rest of your plan is going to be lacking as well. And so it's important to have all of those pieces fitting together.
So I don't really want to dive into the deductions thing because it just there's so many misconceptions.
I kind of wanted to talk
tax,
about the
tax Instagram is crazy. Yeah. So somebody, so tell me, so somebody has, first off, anytime somebody talks about, revenue in their business, I start to just, I don't want to say laugh. Here's the deal. Okay. Revenue is vanity, profit is sanity, and cash is king. So when somebody tells me, "Oh, I did $1 million in my business last year," I'm like, "Great, what do you have?" Right? What do you have?
What do you have to show for that?
That it's the only thing that really counts.
Yeah. You
could do $1 million in sales, but if you only made 10 grand, you made 10 grand. You're really no better off than the guy that did, 50,000 and has 10 grand. And in fact, you're probably almost worse off because you probably put in a lot more work, So that's the gross profit to net profit. And then the net profit to net worth is that's the cash is king piece, right? It's you got to have, not just the net profit, but then, still kind of some profit net of the lifestyle to fund the net worth. And that's the cash is king component. So, let's talk about somebody that has $1 million of, let's say 100,000. I think 100,000 is way more, appropriate. Somebody has $100,000 of net profit in their business as an entrepreneur. Let's say they're what I call like a solopreneur. So they don't have employees. Okay. Right. We'll try to keep it pretty simple. What's next? What do they do? So they got this profit, and let's say they've kept half of it. So they've lived off 50,000. They've saved $50,000 in cash. And, what are some of the things that they might be available or strategies or things you'd look at?
I mean, I'm first going to look at like, what are their goals with this money? What's their timeline on it? Are they going to need to access any of this within the next, year, 3 years, 5 years, 10 years? Or is this what they want set aside for retirement? Because the access is going to be really important in deciding where that goes and how to use that. Just kind of getting a feel for their needs and their goals first is really important before just saying like, oh, hey, go do this. You're a business owner, Like there are different things to look at. But one of the first things that I would say for somebody is look at a Roth IRA. Like whether you're a business owner or not, if you are making under that income threshold, a Roth IRA to start with your investments is a great option. So that's one of them. The other thing is if you can do, in addition to a Roth IRA, a SEP IRA, because you can contribute for yourself as the employer, and then you can also contribute your full Roth contributions as well. And so you can max out both of those accounts.
Yeah.
And so that's a great way to start, especially if you're a solopreneur where you don't have any employees.
Super simple. Way more simple than people make it sound, huh?
Yeah.
I think one of the things that I like that you said there is you got to get a feel for somebody and what their capital needs are going to be. So often people jump right to, well, take all that and, put it in XYZ thing, right? And that might be, depending on whatever lens somebody sees the world through, that could be entirely different. I mean, that could be anything from, some, their buddy's startup investment or something to, buying a vending machine business to buying insurance products or, investing in the market or whatever. Right. And, but once you start playing with tax, sheltered accounts like IRAs, you got to understand liquidity because now you're going to potentially incur penalties if you have to pull money back out prematurely. Roth IRAs are a little bit unique in that you can typically access the cost basis. There's some nuances here, but you can typically access the cost basis without a penalty because you've already paid taxes on it. But depending on the liquidity, so it's going to depend how much they might want to put in each account, right?
Yeah.
What do you do with stuff that's, let's say, so somebody decides how much they want to put in retirement accounts. They run it by their accountant, tax professionals, everyone signs off on it. Yep, that works. And they still have, cash left over. What are some other things that business owners could do or look at to convert that net profit to net worth?
It's a great question. And again, I think it's going to go back to those ultimate goals, the liquidity needs, all of those things too.
Always depends.
Because there's always multiple options. But if they're looking for additional investment type of accounts to put things in, they can always do just like an individual brokerage account that they can put money in.
Oh, yeah.
And that's not technically a retirement account. You can put money in that. You can access it at whatever point. So it's fully liquid. But again, there's going to be some different tax considerations and other things there, but that's one option. Another option, there's like, your simple IRAs, there's the solo 401ks that allow higher contribution limits. I think up to like 66,000 this year.
There's some calculations on how you qualify. And so you always want to run everything past your accountant, right? Make sure that your contribution amounts are sized appropriately for your own situation. One of the things on the brokerage account is that people so often forget that these are all just account types.
Yeah.
They're not investments. So you can invest your money in so many different ways through these accounts. And so where you put assets, there's the whole nother conversation about asset location to have. But, becomes this big trade-off you can do even with just within a brokerage account, right? So, hey, if you need liquidity, right, a brokerage account might be a great place to do it. However, now your next step is like, what do you invest in, right? And there's such a wide range now with money market funds, and you theoretically could buy CDs in a brokerage account, right? all the way up to, complex financial products, stocks, bonds, ETFs, all wide variety of mutual funds, bonds, corporate bonds, high yield bonds, junk bonds, not rated. You could do senior secured. You could do, right. There's all these different, you can pick.
Yeah.
And, most of these things are going to be pretty liquid in the sense that you can, convert it to cash any given day, for a, very similar price to its quoted price, right? Or its assessed value, if you will, right? Whereas like the reason why you would call real estate non-liquid is because if you wanted to sell a house today, right, you'd have to discount it pretty significantly to have somebody come up with the cash and close on it.
Yeah.
Today.
And even then,
right.
It's probably going to take a few days.
Right. So, but hey, marketable securities don't have that problem. That's why they're considered liquid. Now, there's volatility though, is the next consideration, right?
Yep.
So when are you going to need money? Because if you look at like the U.S. economy, it's one of the greatest economies in the world, has been for a long time, and has a very good fundamental tailwind. And so there has been this upward bias to the broad U.S. stock market, and it has continually propelled things higher. It's been a major point to the thesis of the buy and hold, index fund investor, right? The problem is the volatility. It still goes down sometimes, right? Now it might go up, 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 down, down. And so you're still up a little bit higher, but there's the sequence of returns there almost, right? So if I buy today and it goes up, 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 down, down, and all things being equal, right, I'm still up a little bit.
Yeah.
But if I buy up, up, and you go, hey, that's awesome, you're making money, I'm going to do the same thing. And then you get in up, up, and it goes down, down. You're at break even or lost money. And I'm still saying, well, I've made a little bit of money still, right? So you have to understand that you can start investing money, and the market doesn't just print money for people, right? That annualized return number is actually very, very statistically unlikely to happen, right? It's just the average. It's so frequently above that or below that, especially in the equities market because of the volatility, right? So as business owners or entrepreneurs, we also need to have a plan. And we work with clients regularly to develop that and say, if we're in a brokerage account, do we need anything that's tax efficient? First off, is that a major consideration? Is there a major tax sensitivity we have to work with here? Now, what's the timeline for this money? And then the next thing to break down is, what's the likelihood that you'll start needing this money, right? Because if you have $1 million bucket and you're saying, hey, it would only take $100,000 to run all my business operations for a whole year, like this is just excess. Well, to treat the whole $1 million like it's, emergency reserves is somewhat foolish, right? Yeah. But you might want to take 100,000 or 200,000 and treat it that way, especially with how high interest rates are. There's potentially some really favorable return to get with relatively low risk. But over time, it's not going to be over time, it's probably not going to align the most. How do I want to say this? Over time, it's not likely to align most appropriately with your goals. Yeah. Unless your goals are to just end up with the same purchasing power. So if you're super conservative and you just want to maintain purchasing power, maybe, right? Yeah. But so it's always interesting. I call it building a capital stack. Do you have a name for it? Like, do you have ever?
But I like that name.
Yeah, I call it a capital stack with people. So yeah, I tell them like, hey, we're going to layer the account, right? So like, here's what we're putting for your, like if you call up and need money, like this is the first position we're like pulling from. And then what we'll be doing is looking at the market conditions and seeing, do we rebalance some of this other stuff to kind of backfill that hole? Yeah. But we're going to sell this first. If you blow through that, this is what's next, right? And then if you go through all that, here's what's left. You know what I mean? And so you go through those layers. And I have another friend that's an advisor that actually opens up separate accounts for that. So his clients might, have 4 different accounts, right? And that works for him. I don't feel the need to always do that. But it's just different ways to think about it, right?
Yeah. I mean, as long as you're incorporating that into the plan of like, hey, this is my first backstop, second backstop, third, or like, these are my short-term needs, midterm, long-term. I mean, I think that's critical to have as part of the income planning part of your plan.
Yeah. Yeah. Everything becomes income at some point.
Yeah.
Or legacy asset, I suppose. But
it becomes income for somebody.
Yeah. At some point,
whether it's yourself, your kids, the state, who knows? But I mean, you do.
Hopefully not the state.
Yeah. If you have a good plan, you'll know.
Yeah. I'm not a big proponent of dying intestate. So I'll get an estate plan. It's usually a very prudent decision.
Yes.
And that'll help you save some of your assets from going to the state in the form of legal fees. A common misconception is that if somebody doesn't have an estate plan, it goes to the state. They'll find somebody to give it to. You'll have a next of kin. In the state of Utah, so everyone has a plan. It's just the state's plan otherwise. They'll find it. But then what ends up happening is, the estate itself pays all these legal fees and people fight over it and attorneys get a bunch of money and
it's just a long process.
Yeah,
but it does bring up another aspect of planning for business owners is what's your exit strategy? Like at the end of your business, I think it's important to look forward. A lot of times we can get stuck on like, if we're thinking about our goals, like the short-term goals, because that's our day-to-day, that's, like what we're so focused on. But it's important to have those short, medium, and long-term goals, even within our business and for our exit strategy of like, how are we going to get from here to exiting that business? Am I going to sell it? Who am I going to sell it to? Do I want it to go to employees? Do I want it to go to family? Am I just going to let it dissolve? Like, what is that plan? And then also, what's the plan if you become disabled or, something happens to you or you can't run the business the same way that you're running it now? Those are all considerations that business owners should be thinking of and having as part of their overall plan for their business. Because if not, tragedy strikes, something unexpected happens, and then they have to make those really difficult decisions during that time with the emotion and all these other different things going on, and it can just be crazy.
Have you ever had this experience where somebody is like, oh, I'm so glad we met. I will have to talk more. Mm-hmm. I'm thinking about I'm going to sell my business in like 3 years, and I'm going to need some help at that point.
Yep.
And people say that to me sometimes, and the time frame's always a little different. It's 2 years, it's 5 years, and I'm like, you don't need my help then. You need my help now.
Yeah.
And the reason why is because it's planning, right? And it's management, not managed and not planned.
Right. Well, and it's just like for people who are like, when they come and they say, all right, I'm going to retire next week. Like, what do I do?
Well, I had,
it's the same kind of idea with the business.
So like I've seen where somebody sells their business and, they just didn't really put a lot of thought into it ahead of time. And so they said, okay, I put my business up for sale. They sold it and, they got a chunk of cash. And what it did was mess with their Social Security benefits. And we're not talking about like a ultra high net worth, sophisticated situation.
Yeah.
This made a major impact on them. And so they paid a lot more in taxes than they needed to. They didn't get as much on a Social Security benefit.
It can impact their Medicare as well.
And that's where it reared its head, right? Medicare ended up costing so much more. And so all of a sudden, it's like if they had come in and started working on that a couple of years ahead of time, it could have made a profound impact on navigating, by navigating those decisions a little bit differently, with a little bit more foresight and understanding what the plan was behind everything. You can really, really make a big difference.
Yeah.
So
I think that's a huge value add that we as advisors can provide to business owners, looking at their future of how can I do this?
Oh,
Because
yeah.
like you said, taxes, the income planning, like it all just keeps going back to those three
especially
basic
because those
things,
last,
you know?
well, those last several years in their business usually are going to be their highest earning years with some of the most profitability, where if they do it right, they can really set up some great advantages for themselves on that exit. And if they do it wrong, they really can just basically nail their own foot to the floor and then shoot it. It can be pretty brutal when done wrong.
Yeah.
And that's oftentimes what they've worked their entire life for, that moment.
Mm-hmm.
And so that's what, one of the things I've had a friend in the industry say is, you can get a second chance at a lot of things.
Mm-hmm.
Really hard to get a second chance at retirement. So you really just kind of get one shot at it. You got to make it happen just right.
Yeah.
And that's why engaging with good professionals is so important, but also not just, not just engage and say, hey, I'm here, but to say, hey, I'm here. I want to, stay on top of this. I want to communicate. I want to make sure that I get you all the information and all the documentation you might need. And right. And I want to go through this process and make sure we have a well-calibrated plan. Because ultimately, at the end of the day, the scope of our work is always limited by the information that we have. Mm-hmm. So when somebody, comes late to the game and says, oh, I forgot to tell you last year, I put my business up for sale and I close on it this week. It's like, we can't go back and, we can't undo the planning we did. It's like too late in the game. You got to be ahead of that.
Yeah.
And,
especially because there's always other elements that are involved.
Right. But we're in this to see clients to and across the finish line. Mm-hmm. Right. And I think sometimes there's this mental block people have that they don't want to waste our time.
Yeah.
So they want to just, they think we only want to see them when they have money in hand. Mm-hmm. Right. And that's not the case. We almost always want to see you significantly before that. Mm-hmm. Because that's when the value of planning, that's when we can add the most significant value is ahead of time.
Yeah.
Right.
Absolutely. Absolutely. I mean, that's just with everything within our industry, whether that's for business owners, for just the average Joe. If you can get somebody in and start learning about mm-hmm. investing, or you can get them into, different accounts and have them start earlier in life. I mean, I think we've all seen all those charts online on like Instagram and TikTok and whatever that show, the effective compound and in interest. That's the value of time, right? And so if we can come back in and start a plan at the very beginning before we already have certain things in place that maybe we're going to have to undo, or like say, okay, well, that might not have been the best decision, but now we're going to pivot from there and go from here. It might take back some of that time that we wouldn't have had to do if we had got you in earlier.
Yeah. Yeah. The influencer world around all of the stuff is absolutely incredible. It's such a two-edged sword. On one hand, I love that financial education is mm-hmm. getting put out there. I just wish it would come without a lot of the misconceptions that are oftentimes tagged along with it.
Yeah.
A lot of very inaccurate information, incomplete information, misleading information. And a lot of information out of context or completely irrelevant.
And that can almost hurt more than not.
Very dangerous for people. If you started investing like in 20, let's like towards the end of 2020, right? Mm-hmm. All the way through up 2021, you looked like a genius, most likely, right? And if you've held, broadly speaking, there's a decent chance you've done okay, right? But 2022 was a rough year. And so what happens is in the end of 21, everyone's, look at me, look how smart I am. And then you say, well, I'll go do that same thing, right? Mm-hmm. And then you just get your clock cleaned in 2022 and go, and at the end of the day, I'm glad that people want to get involved, but then my concern always is that they start investing in something like 2022 where people aren't explaining to them volatility and the risk of loss, and the difference between a temporary loss of value and a permanent loss.
Yeah.
Right. And then somebody says, man, this whole thing's rigged. I'm not doing this. And they just stop and they think, I'm going to go do something different.
Yeah.
And that always breaks my heart, right? When I hear people say, investing's not worth it or whatever. It's like, it's
Or I
not only is
experience this one time.
Yeah. A bad experience is tough, but oftentimes when people describe it as a bad experience, they're open-minded and they kind of, when somebody just says like, when you start hearing people say something like, oh, it's rigged or it's, this or that, or, I'm going to do something different. Like oftentimes what they pivot to is something significantly riskier. And I'm always scratching my head going, man, you've been so far led astray, in my opinion. It's really quite sad.
Yeah.
So
no, I totally agree with that on the whole influencer thing. I think as fiduciaries, we're required to make sure that we're not misleading our clients. And we're making sure that, we're doing what's in their best interest. We're disclosing fees. We're disclosing all of these different aspects that are not required by those financial coaches online or by these people selling insurance or all these other different things. There's that. Yeah, exactly. Yes. There's that lack of accountability. They're not seeing their clients on a regular basis like we are.
Well, I think that's part of it sometimes too is I do have a lot of, I have probably more faith in humanity than maybe I should sometimes. I think a lot of these people actually mean really well.
Yeah.
I think they're good people trying to do right. I think a lot of times when you get, when you get the client that comes in that says, oh, my cousin did this and he said I should ask you about that, or, it is like, it probably worked out really well for the cousin. And the cousin was probably like trying to give him the best advice, possible. It's just that when somebody's not a professional, if there's no, if you're not seeing and understanding the whole picture and understanding the full dynamic, and then there's no accountability to it either, right? That's kind of like two of the biggest key components, right? Is like, you have to give good, prudent advice in their best interest. Well, in order to do that, you have to understand the situation.
Yeah.
You have to understand their situation because and that's why we get on here. We don't talk about which stock to buy this week or what to buy, what to sell. We don't get on here and make recommendations. I don't even like talking that much about asset classes in general, because I don't want people to, misconstrue that because it becomes so individualized. And then the accountability is like, hey, this is our career, right? And we got to sit across the table from the client every, month, quarter, year, whatever it might be, and answer for the advice we gave them last time, and so it better be in their best interest, and you better be able to stomach that. Now, that doesn't mean that every single recommendation always turns out the best, right? And I always try to help people understand that there is a fundamental difference between bad advice that turns out good and good advice that turns out bad.
Yeah.
And I would rather have good advice that turns out bad almost always in my life. Because if you have good advice that turns out bad and you run that iteration enough times, it will turn out good, right? Or it really should. Obviously, there's a whole nother conversation about statistics and talent probabilities. But if people are giving bad advice, like it can turn out good. But if you keep taking bad advice, it can only turn out good so many times. And invest, like that is the difference in investing, right? Is if you look at some of the best investors in the world, some of the most historically legendary investors, they're not right all the time.
Yeah.
Like Warren Buffett's lost money. It's just that they have a process, and that their win ratio, if you will, is just kind of skewed to the upside a little bit, maybe 60%, 70% win rate, right? Yeah. And that's the difference that it makes. And so you're just trying to make decisions that have the most likelihood of working out in somebody's best interest. Doesn't mean they always will. No one's perfect, right? We don't know what the future holds tomorrow. Life is, although you can predict tomorrow with a certain degree of probability, right? Your prediction isn't certain.
Yeah.
Right. But like, I could say, the sky will be blue tomorrow, and like, there's a pretty good chance it's going to be blue. And I could say it's going to rain tomorrow, and the skies will be gray. And if I say the skies are going to be gray and it's going to be rainy enough days in a row, right? Like, eventually
you're bound to be right at some point.
I'm bound to be right at some point. I'll be the guy outside with an umbrella looking like a genius, right? And how many people do we see do this? That, it's like, I saw this like meme on, I think it was on Twitter one time. Like, it was sometime in 2023, and it was like a legendary investor, and I won't say their name, but he's a well-published author and household name, calls the collapse of the U.S. market, and it says like correctly it's like totally facetious, correctly for like the 12th year in a row.
Yeah.
And it's like, well, obviously over the last 12 years, things have gone pretty well overall. Right. So one of the funny things about that is that this particular person, and this might give away who it is, but if you know, then you know, in his book, he literally says, hey, don't listen to the naysayers. It's not all bad out there. He literally says, don't be a Chicken Little. The sky isn't always falling and everything's going to be okay. Kind of stay the course, keep investing, stick with your plan, and, don't pay attention to the complainers. And I'm like, look at him on social media. I'm like, dude,
that's what you're doing.
You're a big complainer, but it's because it's what gets the most clicks.
Yeah.
It gets the most views, it gets the most attention, and he's not liable for any advice. He's not producing. Yeah. He's not making recommendations to personal clients and managing private wealth. He's selling social media and books, Yeah. So, careful who your trusted sources are, I suppose.
Yeah. No, I think that's huge. Because we kind of got off track a little bit from our
time.
business.
Big time.
But that's okay. We've had some good conversations in here.
We like helping business owners. There's a lot of strategies that we can implement to help them.
I think it's key that you kind of touched on that earlier, that business owners are not waiting until the point where they feel like their business is so successful that now, okay, I need to do something. They need to come in for the planning before they get to that point and start early on. So if there's, any business owners out there who are wondering like, I don't know what this entails. I don't know what planning for my business and planning for my wealth looks like.
Yeah.
Come and talk to us.
Yeah. And if somebody doesn't have, the significant assets for, asset-based private wealth management, you can do, hourly rate or, flat rate, for a one-time engagement to help somebody just sort it out and get on the right track. We have that capability. So anyways, if somebody's feeling like, you're not ready because you don't have the big chunk of money, you can still come in and talk. And I think one of the things that we like the most about our one-page plan that we do for people is it really gives us a good opportunity to understand if we can provide enough value for the clients to make it worth, working together. And if not, we kind of give them, we give them some help and get them set in the right direction.
Yeah.
That way anyways. So
yeah, we just want to help and provide that, even if it's just resources or information for you to go out and do it on your own.
Yep.
We want you guys to be successful too.
Any hypothetical example contained in this document are for illustrative purposes only. They do not represent the past or future portfolio composition or performance of any specific investment and are not intended as investment advice. We suggest working with your financial professional to see which allocation opportunities may be right for you. References to securities indices such as but not limited to the S&P 500, Dow Jones Industrial Average, NASDAQ Composite, MSCI, EAFE, and Russell 2000 reference an unmanaged group of securities considered to be representative of segments of the stock market or overall stock market. These indices may be market weighted with the largest companies in the index representing a disproportional percentage of the index. Investors cannot directly invest in an index. The cost and availability of life insurance depends on factors such as age, health, and type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable. There are several varieties of individual retirement accounts, IRAs, including traditional and Roth IRAs. Tax-deferred accounts like IRAs have conditions that must be followed, otherwise penalties may be applied. Certain actions like rollovers or conversions to a Roth IRA may result in tax consequences. Before contributing, investing, or taking distributions, listeners are encouraged to consult their financial, tax, and/or legal professionals regarding their individual circumstances.